Good afternoon. My name is Chris Konetsky, and I'm the president and group publisher at BPC, which publishes the business record. Welcome to our final Project 515 of 2024, which is being brought to you today by our presenting sponsor, Midwest One Bank, and our supporting sponsors, DLR Group and Iowa Finance Authority. It's our goal to help you do business better. You're all the reason that we do what we do, and this series is designed to do just that. Project 515 is a series of real estate and development-focused virtual events that dive deep into three subsections of the industry: retail, office, and housing. The series has a goal of illuminating future challenges and trends throughout the year while amplifying discussions with the region's key stakeholders that do business directly in the sectors and with those business leaders that are dependent on the health and vitality of the real estate industry. Coverage of the discussion today is going to appear both in written and in video form. It's going to be integrated across our print products and our digital e-newsletters, which I hope you subscribe to the CRE newsletter as well, and on businessrecord.com and social platforms. We've got a great panel lined up for you today that's going to help us take a little bit of a look into the future of the housing sector in the rest of 2024, which is just a little bit, and of course into 2025 and beyond. So we've got a lot to discuss today, and we're excited to get going. Before we begin today, we want to take a moment to thank our sponsors that are making this project possible. Presenting sponsor, Midwest One. At Midwest One Bank, community is at the heart of everything they do, and since 1934, the bank has embraced taking care of their customers in order to help their customers and community succeed. Today, we've got a brief video from Devin Boyer, the Central Iowa Market President at Midwest One.
Hello, and welcome to the Project 515 series. I'm Devin Boyer, Central Iowa Market President for Midwest One Bank, and we are honored to be the presenting sponsor of this year's virtual event series focused on real estate and development. At Midwest One, community is at the heart of everything we do. Since 1934, we have embraced taking care of our customers and those who should be. With our experienced banking teams and proactive approach to generate meaningful impact for all of our stakeholders, Midwest One Bank is committed to providing solutions and resources that will help you succeed. This commitment is one of the many reasons we are happy to support the Business Record Project 515 series. On behalf of everyone at Midwest One Bank, thank you for having us, and please enjoy the event.
Thanks again to Midwest One for your sponsorship today and for helping power this series, and for continuing to support the series into next year as well. Our supporting sponsor this year is DLR Group, who's a returning sponsor from our inaugural year in 2021. DLR is a leading integrated design firm located in Des Moines with offices around the globe and more than 1,000 design professionals. Their promise is to elevate the human experience through design, and I'm pleased to welcome Austin Herndon, the project manager and senior associate here at DLR Group. Welcome.
Thank you, Chris, and thank you to the Business Record for hosting this event. Hello, my name is Austin Herndon, and I'm an architect and project manager here in DLR Group's Des Moines office. I am delighted to begin our discussion today on home selling, buying, and construction, how long Des Moines will continue to see an uptick in multifamily construction, and the effect interest rates are having on the home buying and the rental markets. To provide some background, DLR Group is a 100% employee-owned integrated design firm. Our core disciplines include architecture, engineering, interior design, and planning services. From the creation of community-centric new construction, including institutions and mixed-use developments, to the adaptive reuse of existing spaces, including housing and lifestyle hotels. Our brand promise here at DLR Group is clear: to elevate the human experience through design. Our expertise spans across a diverse spectrum of sectors, including educational institutions, culture and performing arts, hospitality, mixed use, retail, multifamily, and workplace design. Today, we will be digging into housing. Within the multifamily housing market, our talented team of designers create spaces where people want to spend their time. Nothing is more sustainable than a place that people love. We recognize that spatial requirements are ever evolving, responding to the unique needs of the intended user and their surrounding community. At DLR Group, we are committed to a collaborative approach, actively listening to users and engaging with the community and housing advocates. Our goal is to elevate the role of the residential space by crafting environments that evoke relaxation, inspiration, locale, comfort, safety, and togetherness. Today, our panelists will explore the housing landscape here in Des Moines, but I'd like to start with what we are experiencing across the country. From reimagining the largest and oldest housing cooperative in the Western United States with Freedom West Homes in San Francisco, to restoring a historic brick automotive shop into the porte cochere and entry of a new 14-story co-living apartment complex in Los Angeles County. From expanding an off-campus housing option for college students in a high amenity-driven brand, to reinvigorating downtown Kansas City with a new 27-story mixed-use high-rise tower that will offer tech-savvy living environments and a lifestyle hotel. Each of these projects has its own unique story, adding value to its surrounding community. Whether through providing buzz-worthy public spaces, incorporating local art, or a retail program to draw on the community, these housing projects create an ecosystem in which all needs are within the grasp of its residents. And as our awareness of our eco-footprint continues to grow, the shift towards prioritizing sustainable goals will soon be viewed as a fundamental necessity rather than a mere luxury. Sustainable practices like energy-efficient design solutions, renewable energy integration, and convertible layouts all contribute to minimizing our environmental impact. The future of housing design is at a convergence of innovation and sustainability and human centricity. Now, let's extend the conversation to our panelists for their thoughts on the evolving landscape of the housing markets here in Des Moines. On behalf of DLR Group, thank you for joining us today, and thank you to our panelists.
Big thank you to Austin and the DLR Group for helping support the Project 515 series and for all the great work you do here in the community. Our final supporting sponsor today is a new sponsor to our 515 series, the Iowa Finance Authority. IFA is helping to create opportunities for Iowans, communities, and businesses to thrive by connecting people with affordable financing resources. Please welcome IFA's Communications Director, Ashley Jared. Welcome, Ashley.
Well, thank you, Chris. Thanks to Chris and the Business Record for hosting this really important conversation today around housing. Very important and near and dear to the hearts of all of us at the Iowa Finance Authority and Iowa Economic Development Authority. Super proud to sponsor today's session for you all. We all know that meeting today's housing needs is going to require some strategic thought from community leaders, business leaders, employers, etc. So the Iowa Finance Authority and the Iowa Economic Development Authority are very excited to have launched in the past year 3 different incubators to drive innovation across the housing continuum, starting from innovation in homelessness, the homeownership incubator, and the rental set-aside incubator. So really encourage community leaders and thought leaders, such as everyone on this call today, to check out more information on all of those. You could potentially get funding to make a really innovative idea become a pilot initiative, and who knows, perhaps statewide initiative to really drive innovation to meet our housing needs. We know that we're going to need about 25,000 additional housing units by 2030 to meet the robust needs of our workforce. And so that is going to require a collaborative effort. So in closing, I will just say thank you so much again to the Business Record for hosting this really important conversation. And we really look forward to being part of the conversation going forward. Thank you.
Thanks, Ashley, and thanks again to IFA for your sponsorship and for everything you do to help support housing here in the community. A big thank you again to all of our sponsors for helping support the series. We've got just less than an hour here to cover a lot of ground, and I know Kathy and the panel is itching to get started, so we're going to go ahead and get started with that. Kathy Bolton is our senior staff writer. She covers real estate and development with a specific emphasis on housing. We're devoting a little bit more of her time and energy towards this topic. We think it's a critical one, and we think there's a number of stories that need to be being told about this. And so she's going to be spending more and more time on that area. She also covers workforce, housing, and banking for us as well. Kathy, I'll go ahead and let you take it away.
Thanks, Chris. And we are going to get started. I want to introduce this great group of panelists we have today that's going to talk about the residential sector and sort of the outlook for the 2025. Our panelists are from a variety of backgrounds, and they include Rachel Flint. She's the Senior Vice President of Home Building Operations for Hubbell Realty Company. Sean Fogarty, he's a partner in Artisan Capital Group. Larry Goodell-retail mortgage manager at U.S. Bank. Lance Henning, he's the CEO of Greater Des Moines Habitat for Humanity. Sarah Hopkins, realtor with Remax Precision. Aaron Messmer, Executive Vice President of Block Real Estate Services. Thank you, panelists. I know you're busy, so taking time out of your day to be on our panel, we certainly appreciate it. So let's get started. In the past couple of years, the housing market's been exceptionally challenging for home buyers and sellers and the businesses associated with it. Mortgage rates are higher than they were a couple years ago. costs to build a new home have escalated. Prices are rising for existing home sales. So let's just take a start and look at mortgage rates. In January 2022, the average interest rate for a 30-year fixed rate mortgage was 3.22%. Last week, it was 6.81%, and I saw that it went down a little bit today. Larry, a couple weeks ago, Fannie Mae's Economic Strategic Research Group revised its mortgage rate forecast, saying it no longer expected rates to dip below 6% in 2025 and probably would stay above 6% through 2026. Do you agree with the group's assessment?
Well, I wish I had a whole bunch of data that would refute that, but it's probably, going to be, in that 6% range. I hope similar to this year, it trends down throughout the year. I think, rarely, mortgage rates tend to move a lot on anticipation of what's coming. So, short-term interest rate cuts, that type of thing. And, as you noticed, when the Fed finally did cut rates, actually mortgage rates went up. So, just with it being a huge global economy, I think that mortgage rates will, we'll have some periods of time where it'll dip down, hopefully closer to that 6% and maybe even in the upper fives throughout next year. But I kind of expect a similar year to what we had this year, where it's, ranging between that 6 and 7, and hopefully, gets down, below that 6%.
So when the Fed cuts the rates, why did the home mortgage rates go up?
Well, the short-term rates really don't affect mortgage rates. So the Fed's cut, like I said, it's the rates were down before the rate cut in anticipation of hopefully that they were going to cut by 50 basis points. So, actually the actual event really didn't have any impact on mortgage rates, and they were already priced in with that reduction prior to that time.
Got it. So if rates remain in that 6% to 7% range, what sort of impact is that going to have on applications for new home mortgages or for refis?
Well, again, I'm an optimist. I'm hopeful that, activity will pick up. I just, I think the farther we get, from the 2, 3, and 4%, the farther back that is in the rearview mirror, we're going to have consumers are going to want to take action. They're going to want to move to a bigger home, and they're going to want to downsize. They're going to move to another area or a different home that better suits their needs. And, they won't probably be tied quite as closely to that, that 2 and 3% mortgage that they have right now.
And if rates stay above the 6%, how does that affect housing affordability?
Well, affordability is still a challenge. I think if we start to see some more people more bringing their, moving up, and that opens up the lane a little bit for the first time home buyers. So some of the more properties come on the market, that's gonna increase our inventory. And I think, with that, that may slow down appreciation. I don't think we're not going to see depreciation, but I think if we can just slow it down, and then people can look at where they're at right now, look at that affordability, and know that if they get in today, the interest rates may go down, but they can get in at a price point where, if they wait a year, that price is going to be, anywhere from 2 to 5% higher than what it is today.
And then can you today's rates are range between 6 and 7%. When you look back, how does that rank historically?
Yeah, I think historically over the last 30 years, I think the median rate is probably 7.25%, somewhere above 7%. So, really rates aren't that bad, but I think everybody still remembers, the rates that we've had the last few years. And I think over the last 10 years, that median rate has been around 4. So it feels like, they're really high, but it's just because that's kind of what people have been conditioned to the last 10 years.
I'm old enough to remember when mortgages were in the double digits for interest rates, so 6% seems okay. So Sarah, nationally, one of the problems real estate professionals are citing is that people are staying in their homes and not selling. In the greater Des Moines area, we've seen the number of houses, though listed for sale, increase a little bit. In October, there were nearly 4,000 listings, about 600 more than a year ago. So why don't you describe what you're seeing in the supply of homes for sale in the Des Moines area?
Yeah, so it's easy to look at the number of homes currently for sale and equate that directly to a rise, a fall in inventory levels. But what's actually happening right now is that we're seeing less homes go under contract. So when you look at the homes being listed each week last year compared to this year, it's relatively about the same. The difference is that right now, they're not going under contract. So homes are remaining on the market, which is bringing that rise in inventory levels up.
So what I hear you saying is their houses are staying on the market for a longer period of time, and just the rise is because more and more houses are
correct.
coming
So the
onto the
same
market.
number of homes are potentially coming on the market, but they're not selling, or they're not selling as fast. So it's bringing more inventory to the market. And the reason that those homes aren't selling right now is a direct impact of the higher interest rates.
Okay. And another reason homes may not be selling is because median prices are going up. In June, the median sale price was $307,000, according to the Real Estate Association here. It was the first time it's been over 300,000 ever, according to my research. And then in October, it was 289,900. So what's making the median sale price rise?
So a higher median sale price is also a direct result of lower inventory. So during COVID, when we had the insane low interest rates, 2.5%, 3%, combined with a severe shortage of inventory, we saw prices just absolutely skyrocket. The peak of that was probably June-ish 2021. So fast forward to today, and a lot of those home buyers that were in that price range, they're not selling their homes. They either refinanced during then, or if they did purchase a new home, they're really golden handcuffed to that 2.5% to 3% interest rate. So they're not putting their homes on the market. The homes that are coming on the market, we still have such a shortage of inventory in that price point of $250 to $325. There's a real lack of inventory. That's keeping those prices the same. So if somebody does list their home, they really want to get the same price as what their neighbor got back in 2021, meaning home prices are not coming down. There's still a shortage of inventory in that area, which is rising median prices up. But if you look year on year, it's really kind of a standard rise in median sale price.
Great, thank you. And Rachel, you're active in both the Des Moines area and Iowa Home Builders Associations. Sort of provide us with a brief overview of home building market in Des Moines and then in Iowa.
Sure. Well, thank you all for having me here today. Very happy to do that. But Sarah is absolutely right. When you're looking at new construction, the actual time on market has increased over last year by 20%. So the average days on market for new construction is about 151 days. So that is an increase that we are seeing there. But overall, the shortage of existing home sales or existing homes for sale has driven buyers towards new construction, which has provided builders with a strong market. There are pockets of oversupply. You'll see that in Waukee, particularly with new construction. I think there's over 260 ranches that are available for sale just within the city of Waukee. But year to date, over 2,000 new homes have been sold. That's 70 sales ahead of last year, which indicates a healthy and active market. Overall, lot supply that we're seeing in the market is strong. But average lot prices within the metro have increased. They're over $85,000 a lot. So it is not cheap within the metro. And you're starting to see more people move to the outskirts of the metro in order to get more affordable lots.
When you say outskirts, Rachel, where are we talking about?
Van Meter, any of those, all the kind of those little smaller towns that are just 10 to 15 minutes outside of what I call the metro, so to speak. But I think there's still challenges that remain, right? Rising interest rates, that higher borrowing cost impacts affordability, material costs. So the material costs have continued to fluctuate. We saw actually lumber come down quite a bit from when we saw it in 21 and 22. But those fluctuations impact construction costs, and potential tariffs, I think, are the number one concern for builders. All of our lumber comes from Canada. A lot of our electrical equipment comes from Mexico. A good portion of the other parts of the home come from China. So we can only hope as home builders that the threats of tariffs are a bluff. And then I think the other thing that will impact us in the coming years really are labor shortages, right? Finding and retaining skilled construction workers is challenging. It leads to delays, increased costs, because labor costs aren't going to go down. I don't know how many people out there have actually experienced less money than they made the previous year, but labor doesn't tend to go down. So that's going to keep escalating. And then I think transient workers, which construction relies upon heavily, the framing, all of that, that's going to be harder to come by in the coming months ahead.
So you mentioned the price of building materials. So what are some of the things home builders are doing to help lower that cost of a new home?
Right. So there's a variety of things. I think a lot of us are looking at lean building, right? We've gone through and figured out, are we sending too much materials to the job site? Are those things that we can really get tight on to make sure that the house is being built as efficiently as possible? I think home sizes are actually starting to get a little bit smaller. In order to be more affordable, you actually have to get smaller in order to make that happen. Houses don't get bigger when that happens. So there's just a variety of things. And I think also we're looking at deregulation. How can we fight regulations that are put on home building industry that don't say have a 10-year payback? That's really kind of the crux. Is it going to have a 10-year payback for that borrower or for that buyer of new construction?
So when you talk about the size of a house being built, how much has it shrunk then in the last, is it smaller now?
It is. I think average new construction, you're seeing more homes in that 1,400 square feet range, whereas the 1,600, 1,700 was more popular probably about 5 years ago.
And then I've also seen an uptick in townhome construction. Why the uptick? And are these products for sale or rent or both?
Well, I'm going to say the uptick in townhome construction is primarily driven by the burgeoning rental market, right? The rental townhome communities. Hubbell Homes, we just built 123 rental community in Waukee, rental townhome community. So there is significant and growing demand for rental housing options that offer more space and privacy than your traditional apartments. So rental townhomes effectively bridge that gap between apartments and single family homes, appeals to a wider range of renters, including young professionals, families, and empty nesters. So there is strong demand for that. And I think the cost gap ownership to rental, that cost gap is still significant. To have your mortgage payment be equivalent to what rent would be, oftentimes the down payment would have to be greater than 40% down payment to get that rate that close to even being relatable. In contrast, I think the decline for sale townhome construction can be attributed to several things. I think if you look at year to date, there's been 499 townhome sales in our metro. That is about 102 behind what we did this time last year. And that's an impact of higher mortgage rates. At the end of the day, it does make it more challenging for buyers to qualify. And I would say the overall increase in housing costs, coupled with rising inflation, has squeezed that affordability. But the biggest thing that we're seeing in townhomes for sale is that increased cost in HOA dues, which is directly attributed to the rising insurance costs. It is not cheap to insure a fourplex in a community and insure all of the exterior items in that community.
Great information. Thanks, Rachel. So let's shift the conversation a little bit. Erin, tell us a bit about Block Real Estate Services, when and why it entered the Des Moines market, and then shift over to the Rouen 2 project.
Sure. Thanks for having me, Kathy. Block Real Estate Services is a owner operator developer out of Kansas City. We kind of got roped into the Des Moines market in 2014. We had a friend of ours here in this world work on the equitable conversion of that project in downtown Des Moines. And we really found a great community. And so since then, we've bought 8 industrial properties, 2 multifamily deals, a couple shopping centers that we're working on some value add renovations there. And then we have a handful of medical properties as well. So in Des Moines, Ames, and Iowa City. As far as 2 Ruan goes, there was really a natural fit for us. It's proximate to Equitable. They're right across the street from one another. That allows us to have shared services, shared management. And really, we were introduced to the Ruan family and to Tracy Ball, who's one of their team members. And we really just clicked kind of immediately. So when you see the world the same way, a lot of times that makes that a lot easier. And happy to have found a great partner in that project and a city that was open for business and looking for continued conversions. So we're excited about the direction that one's headed.
Tell us where you're at in that project.
Yeah, so we have our plans completed. We actually just got turned down for the next round of state historic credits. So our hope is to get the award for next year's state credits. We do have our application in for the federals as well. Those are a little more automatic. They're not a competitive process. And then we do have our incentives approved by the city of Des Moines as well. So we're pretty much ready to roll, but for that state credit, that's a pretty vital component to the capital stack. And like I said, hopefully if we get an allocation next year, that'll be the mechanism that allows us to move that ahead.
Well, good luck with that.
Yeah.
You and I have talked a couple times about some of the challenges that you face in converting an office building to multifamily or some other kind of building to multifamily. Talk a little bit about the pros and cons of the conversions, and if somebody was looking to do that, not that you want them to be your competitor, but what one piece of advice would you have for them?
Yeah, I think there's a lot of pros in doing these building conversions. You get to reallocate the inventory in a downtown environment to meet the demand. So if we need fewer offices, but more residential units, that repurposes those existing buildings and really helps revitalize that urban core. So I think that's really great. They are proximate to employment centers a lot of times. So you do have good draw there from folks that want to live near where they work. You can do your work year round. So you're not building ground up in a frozen, environment. You can come in and start work in January if that's when you want to do it. So you're not really subject to winter conditions in a lot of cases. And then really you get to work in some very cool buildings. If you look at Equitable with the Gothic style architecture, we had a great party last summer to celebrate our 100-year anniversary. That's just stuff you don't get to do with a new ground up deal a lot of times. And so just the stories that come with those, and people tell you, hey, my grandfather used to office in that building, or, we grew up coming here for this or that, that kind of thing. Those are really neat. As far as the cons go, you're always going to be constrained to the floor plate that you have. That's why some buildings are better for conversion than others. They're better candidates. So you're looking for things where you can get plenty of natural light into the units and things like that. It's a lengthy process. It's not the same as picking a cornfield and putting your standard deal on it and stamping it again and going forward. So there's a lot more design intent that has to go into it. You start peeling back the layers. We actually started demo on the interior of Ruan, even though we're moving ahead, on that kind of speculatively, waiting for the historic allocation to come down, because the more you can peel back behind the walls, the better you can see what you're going to run into eventually. At the Equitable, we had the joy of discovering a lot of places where they use clay tile, if you can imagine, and how to attach to that and stuff like that was maybe an unpleasant surprise there. So it's a longer process, and you want to know as much as you can know. There's a 5-year compliance period after you finish construction and place the building in service. So they're just a little bit more The duration's longer, they're a little bit more complicated than maybe your traditional ground up deal. Advice would just be to have contingency in both your budget and your timeline. I mean, you're going to need more of both than what you hope or what you think or what you're trying to do. So, we typically have an allowance for that. I mean, just look at our current situation where, we're basically pushing the clock back by 9 months while we wait for the state credit to come back through maybe next year. So that's just part of the process. And, while you always hope for the best, you got to plan for the worst. And that's kind of part of how we approach it.
Thanks, Aaron. So, Sean, tell us a little bit about Artisan Capital Group and some of the properties you've acquired recently in Central Iowa.
Great. Thanks, Kathy. Thanks for having me again. I'll try to keep this pretty brief. Artisan is an owner operator of apartment communities. We were formed in 2017, so fairly new firm. Our ownership consists of 3 partners, myself, Ryan Callahan, and Mike Perry. We do operate out of 2 offices. We have a downtown Chicago office right on LaSalle in the Loop. And then our Des Moines office, which I'm sitting in today, is on the kind of the Western Gateway, 17th and Grand. We sit in one of our in a retail space in one of our apartment communities, Gateway Commons, if some of you are familiar. We have two companies. Artisan Capital Group is our investment arm, handles our transactions, asset management, other personnel functions. And then Artisan Management Group is our vertical, property management vertical. Artisan Management Group manages the majority of our properties, not all. We do have some student deals that are third-party managed. And all between the 2 offices, we have about 25 folks at the corporate level, split between Chicago and Des Moines. Overall, I think we're about 145 total employees, including on-site personnel. Right now, we're about 7,100 units that we own and operate. Again, our forte is market rate apartments. We do have some student housing. Our focus is really Midwest market rate, value add, opportunistic properties. We like to do a lot of unit renovations, amenity renovations, but we'll also look for a good story regarding management upside, those things. Anyone who does value add, pretty similar stuff. Right now, the majority of our portfolio is Iowa based. I think we have about 2,400 units in Des Moines itself. We love Des Moines, but also own in Kansas City, Chicago, Omaha, Evansville, Indiana. Soon we're going to bust into Minneapolis here in the next, hopefully next 45 days. Couple mentions of properties we bought recently in Des Moines. We bought Cityville on 9th, who some of you are familiar. It's down just south of MLK. It's part of kind of the Grays Lake developments down there. It's 312 units. And we also bought a 382 unit deal, Wakanda Village, if you're familiar, next to Wakanda Country Club off of Fleur Drive. Couple last things to note. We are not developers yet. We are, poking our nose into the development game. I think if we enter the development game, we'll do that here in Des Moines. We're very familiar with Des Moines. And then, our overall goal is to continue growth here in Des Moines and throughout the Midwest.
Great. So we've talked a little bit about affordability. How is the difficulty in being able to buy a house? How's that affecting the rental market in your perspective?
Yeah, the overall impact of higher interest rates is typically positive for the rental market. You don't lose a lot of folks to the backside that are buying homes or condos. So we definitely have seen that. We've seen a slowdown of folks buying homes and departing your apartment complex for that. I would say, even before the run up in rates and before the pandemic, probably the last decade, there's just been there's been a shift of folks that are, they're apartment renters by choice versus necessity. There's a lot of folks, whether they're entering the job market, entering the rental or housing market, that want optionality and flexibility. Again, younger generations tend to move around more than when I grew up. And some of us grew up. So they want optionality, flexibility, that they're not stuck with a mortgage and they want to move from, Des Moines to Los Angeles or Chicago. So we've definitely seen a shift of that. I would also say empty nesters, we've seen in the market more the last decade or so, post-financial crisis, that want flexibility, optionality, whether to park their investments someplace else versus their house, or they want to spend 6 or 9 months in Des Moines and, 3 to 5 months someplace else warmer.
And then
I'd
talk
like-
a little-
Go
ahead.
Sorry. I
Go
was
ahead,
just going to jump in on that. He's absolutely right. Even on the
Yeah.
for sale side, we are seeing more and more empty nesters moving to Iowa, or people reaching out saying they're going to be moving to Iowa next year. These new tax changes that have happened in the state, my own parents live in Illinois. Their tax advisor told them to move to Iowa. It is much cheaper to be in Iowa than it is in Illinois. So I think we're going to start to see more and more empty nesters in the coming years due to all of these new legislative changes.
Is that a good thing?
I think it is. You're going to have your grandparents here next to the grandkids for at least a good half of the year. I think you're still
Mhm.
going to have snowbirds, but I think it's a good thing for our market.
Sarah, are you seeing the same thing?
Yes, absolutely. Definitely an increase in those empty nesters, the ones who their mortgages are paid off. So they are not tied to that 2.5%, 3% interest rate. They're going to move no matter what. That doesn't impact them.
Okay, great. And Sean and Aaron, talk a little bit about interest, rental rates and where you see them going in the next year. Sean,
ahead,
start
Aaron.
with you. Or-
Oh, go ahead.
Yeah.
You want me to go?
Go ahead,
Aaron.
Sean. Go ahead.
The great thing about Des Moines is it's very steady and solid. It's not sexy. I think, I've primarily spent most of my career investing in the Midwest or working for folks that are investing in the Midwest or transacting Midwest. And the rental rates here in the Des Moines area, if you look at the CoStars and other research tools, they're quoting anywhere from 1.5%, 2% up to 4% in certain submarkets. I think that's right. On certain deals that we own here, our trade outs or our year-to-year turn of units can be higher than that, but that's in part depends on where those rents start. So I think Des Moines will continue on a steady, stable rental rate increase. Everyone looks out for supply. Supply, Aaron will speak to this probably more than me on the development side. Supply has been fairly muted in most markets because of some of the things we talked about in construction costs, et cetera. You've got to watch your supply a little bit in certain submarkets, and we're seeing some of that in certain submarkets here, but overall pretty steady rental and both rental and occupancy trend here in the foreseeable future in the Des Moines Metro is what we're seeing.
Yeah, I think that's
Aaron?
right.
Anything else you want to add, Aaron?
I think that downtown probably took a hit on their rental rates. I mean, that's where we've got a couple of those communities with COVID and some of the employers not requiring their folks to be there. We definitely saw kind of a retrench at the exact same time that a lot of stuff came online downtown. So to Sean's point, supply is a factor in that. I think that we've kind of leveled out, and maybe 23 was the year we got our footing for occupancy, and 24 is the year we started being able to push rents again.
Okay, thanks.
I'll add to that real quick too. Yeah, there's definitely some softness downtown. When the Wells Fargo's and the world's kind of pull back and Nationwide goes remote, there's impacts there. But if you talk to folks that are living down here and others that want to live down here, there's definitely a demand for living here, but totally agree with Aaron. Downtown's been softer than some of the suburbs recently.
Yeah, we do see a pretty good demand from folks that are coming in from out of town. So if you are from Chicago or from another market and you're moving to Des Moines, we do see quite a few people kind of want to locate in that area. So that's been a big plus for us.
Great, guys. So Lance, I want to bring you into the conversation. We've talked a little bit about housing affordability. Tell us a bit about what Habitat's doing to make home ownership more affordable.
Yeah, Habitat for Humanity, we continue to work with hardworking Central Iowans that are trying to reach the dream of affordable home ownership. And we work across 3 counties in Polk, Jasper, and Dallas counties. And that's, I think, one of the things that we are spending a lot of time that people think of Habitat as the home building side. We have mortgage consultation that we do. So anyone can reach out to us and we'll help them understand where they sit today as they think about home ownership. And that we can walk them through where they are in their credit and how they think about what they need to do for their next steps. So helping them to become mortgage ready. We worked with 200 households this year in that mortgage consultation and helping people understand where they are mortgage ready. We also have our home preservation where we're helping people stay and remain in their homes, repair side, helping people to be able to, if they need a roof replacement, furnaces, need a ramp, and we're working with 175 households this year in that. And then the home ownership program is the way a lot of people know Habitat for Humanity, working with volunteers and building the homes. And that we really do that through both new construction and renovation, working with the community, and that we are working with families that earn below 80% of the area median income. I think one of the things on there is that is a large part of our workforce. So a family of 4 earning $90,000 or less would be under 80% of the area median income. And the buyers, then they complete our home buyers education and counseling, do some sweat equity, and then they purchase the home with a Habitat mortgage, which is below market rate. And we set that so that they pay less than 30% of their income to be able to cover their housing costs. So moving 36 families to homeownership this year.
And then you'll be looking at doing a new project in Waukee, which we just put the photo up here of Walnut Crossing. Talk a little bit about that and why in Waukee.
Yeah, we are excited about Walnut Crossing. So that is 48 townhomes. You see it's 4 plexes. There's a few 2 plexes. We'll be putting the infrastructure in early next year and starting to go vertical the later part of next year on that, and take a couple of years to build all 48 out. And that I think it's an exciting piece on there. It's a great partnership that can be a model that can work across the entire metro area. Thinking about public-private partnership, Waukee really, I think they realized that they had many people that worked in Waukee that couldn't that could not afford to live there. And so they were trying to find the right ways to start to take action around that. And one of the comments that Mayor Clark made too was that someone doesn't need to, if they want their child to go to Waukee schools, that they shouldn't have to be rich to be able to do that. And so the city has partnered, helping to provide the land, helping to provide a TIF. The state is helping out through workforce housing tax credits. And then Habitat donors are also helping provide support on there to create those 48 townhomes and make those affordable for hardworking families that want to live in Waukee.
Are those townhomes going to be for sale or rent?
Those are all home ownership. And so Habitat's programs are home ownership programs. And that they'll be, most of them are 3-bedroom, 2-bath, about 1,300 square feet. And then there'll be a few 4-bedrooms that are mixed in there as well.
And then you kind of touched on this, but there's a lot of retail hubs in the Des Moines area that employ people at the sort of lower end of the salary spectrum. Talk about, from your perspective, why is it important to have affordable workforce housing in communities where all the jobs are at,
Well, first, more people are getting priced out all the time. And if you look back, just really, even if you look back 2 decades ago, some of that lower income spectrum could just afford a new house that was on the market on there. So lower middle class didn't have a problem purchasing a house. Today, you really need to almost be in the upper middle class to be able to purchase on a new house on there. So a couple decades ago, 20% below median income could buy a house without a problem. Today, you need more than 30% to be able to, 30% above the median income to be able to afford a new home. And so when you think about the workforce and what it means to employers that, people are more invested in a part of the community, stay at their employer longer if they live closer to the employer. And then for the individual, you see pieces around where they save on the transportation, and that they do get more involved and engaged in the community. And I think those are all key things on the civic piece. And then there's also around just being able to have choice and opportunities to be able to live where you work is something that folks should be able to choose between.
Thanks, Lance. So Larry, talk a little bit about some of the options or programs available to home buyers to help them with down payments or closing costs.
Sure. One of the sponsors, Iowa Finance Authority, is a big part of affordability in housing. So, we offer that program, and almost all lenders, most lenders here in Iowa have that program available. A lot of lenders have their own programs, and as well, U.S. Bank, we've got an American Dream program. You can get in for as little as 3% down. You can get up to $10,000 in assistance for closing costs, down payment, or prepaids, and you can. So technically, you can get into a property for as little as $1,000 of your own investment, which is a big help. And then there's no private mortgage insurance that's covered by U.S. Bank. So that's our particular program. And as I said, I know a lot of different lenders have their own proprietary programs, and to help for affordability.
Are you seeing an uptick or an increase in people taking part in those programs?
I think it's real, very consistent, especially, we're seeing a lot of activity in the immigrant section, people that are coming to, they're in Des Moines want to become homeowners, and they're utilizing a lot of these different programs to help with affordability. So.
And then recently the Mortgage Bankers Association issued a report that in the third quarter, about 4% of the mortgages were delinquent by 30 to 90 days, which was higher than a year ago. What is U.S. Bank seeing in terms of delinquencies?
Yeah, we don't disclose that information, but I know, for the last few years, mortgage delinquencies have been at record lows. So I think it's, obviously we've had a couple of years of increased interest rates and payments and that type of thing. So it's really natural that, delinquencies do kick up, but I know that they're still below expectations, or below the averages nationally. Or historically. And, I think, I know we focus on sustainable, affordable housing. And I think, kind of like what Lance talks about, and having people come and talk to a qualified or a, professional, mortgage professional, you can really dig into not only what you can qualify for, but more importantly, what you're comfortable with. And I think that's the key, to keeping people in their home, is that they, because, year two, your property taxes may go up. So that escrow payment is going to increase. So that payment isn't always static. And so it's really important that you go through all of the things about buying a home, and, you're going to have certain expenses. So it's just important to talk with somebody that's going to help you walk through all those different scenarios, and make affordability and make homeownership the exciting thing that it's supposed to be.
Great, thanks. Sarah, talk about, look in your crystal ball and tell us what you think home prices will do in 2025.
Oh, so again, touching on this, it's all about affordability for home buyers. What buyers could buy 3 years ago for $300,000, they're now looking at a home at $250,000 because they don't have as much buying power. So I really think 2025 is going to come down to what happens with interest rates. If we could get even a slight drop in interest rates, I think if we could get under 6%, It'd be great even at 5.75. I think we will see buyers come out of the woodworks. I know right now, a lot of buyers I'm working with, if they don't have to move, they're not moving. They are choosing to rent. They're casually looking. Buyers are being far more selective. During COVID times, when interest rates were so low, a buyer would happily overlook issues with a home or maybe changes that they needed to make. Right now, with these interest rates, buyers can't afford any more in their monthly budget after their mortgage is paid. So they can't buy homes that they can plan to fix up or make changes down the road. They really are having to buy homes that they can afford, and it's a lot less than what that was a while ago. Do I think that will impact housing prices? If our inventory remains the way it is right now, no, I don't. We do not have enough of an inventory surplus to make housing prices come down.
And then you mentioned earlier, sort of what is the need, what price point is there the most need for housing, and how do we get it?
Yeah, that's a good question. 7 years ago, it was possible to find a house under $100,000 that you could fix up. Right now, all of those $100,000 and under prices are going to investors and cash sales. You really need to get above $200,000 for buyers to find a home that can be livable. And we have a huge shortage of inventory in that 200 to 300 price range. I personally am seeing a lot of my buyers take advantage of the programs such as Iowa Finance Authority, Neighborhood Finance Corporation. The fact that they've extended throughout so much of the city is huge. Buyers that previously would have never considered programs like that are now working with that because they don't have the option to find a lower priced home. They're trying to get creative and figure out how they can afford the homes that are out there. Having entry-level new construction between that $300,000 to $400,000 range is also really helpful. That can at least get people into homes, but they're having to compromise. They're having to sacrifice space. They're having to just adjust their expectations.
Okay, and Rachel, talk about maybe some of the incentives builders are offering prospective buyers.
Sure, they are. They definitely are out there. I would say the biggest thing that's out there are rate buy downs. So what that means is the builder will contribute to buy down the interest rate on your mortgage, whether that be for a 2-1 buy down, say buy it down 2 points for 1 year, or if it's even on a 30-year fixed. Now, I can tell you, we offered a full 1 point, and on certain select homes up to 2 points, full rate drop on a full 30-year fixed. Guess how many people took advantage of that? 1. Do you know what they chose instead? The second most important thing, the appliance package. They would rather have a refrigerator, washer and dryer, as opposed to having $50,000 off of your mortgage over the life of the loan. So it's very interesting what people will take, what they will look at. Just sitting down, taking the time to look at the numbers, the life of the mortgage, what your monthly payments are. Sometimes they'll pick those appliance packages over anything else.
Is that
The
because
third
they
thing that we
think they're going to
see-
refinance the deal?
Yeah, I think that's it. They just think it's short term, and I'll rates were down for a long time. They'll come back down and I'll refinance it. Or they just don't want the out of pocket expense of having to pay cash for, or put it on their credit card at a 20% interest rate, to buy those appliances that they're going to need no matter what. The other thing that we see are closing costs. Sometimes you'll see up to $10,000 in closing costs that will be offered. So that's there. And then of course, there's just price reductions. I think builders are very aggressive on pricing, and that's something that I think will continue into the next year.
Okay, thanks. And Sean, do you see more people coming into the Des Moines area market like Artisan and investing capital here?
Yeah, definitely. I mean, my experience, and I grew up in Des Moines, so I moved to Chicago and came back for 20 years and came back, but I was a broker for 15 years, up until 2019 and joining Artisan. And, what I would say is when on the broker side, it was difficult to get investors here. Even just a decade ago, it was a lot of discussions about Des Moines, all the dynamic things about Des Moines, and really selling Des Moines. That's really changed in the last 10 years. I think post-financial crisis, there's been a lot of development, multi-housing. I mean, Aaron understands this and others. Our market for multi has gotten bigger and things have been transacting. There wasn't a lot of large-scale transactions 10, 12 years ago. So I think in summary, there's definitely a lot more regional and national investment here the last 10 to 12 years. People understand Des Moines. When I moved to Chicago in 1999, I think the MSA population was about 425,000. I mean, Des Moines approaching 800,000. That's probably still the top key thing about when people look at the size of Des Moines. It's closer to 800,000 than 400,000, and that's important to a lot of folks. Besides all the great things we have in terms of employment diversity and steady jobs and schools, etc.
Great. And then Aaron, quickly, we see a lot of conversions going on downtown with your project and a couple others, and then new construction. Is downtown getting oversaturated with apartments, or can it absorb more?
I think it's just going to be a function of the pace of jobs, which jobs are downtown, which folks are being called back into the office downtown. I think principals bringing everybody back, which is a big encouraging sign for us. But housing follows jobs, and downtown is going to be no exception. I do think that there's been a decided pause or decrease in the amount of supply delivery down there. We kind of had a sort of convergence of sort of the worst of all the scenarios, where we had a lot of delivery right in the middle of COVID when downtown was maybe not so hot to trot. That caused some folks to back off. But I do know you've got several projects that are in the process of delivering or under development. I know the Landmark guys just got their incentives, or they got their state credits, so they're going to be doing their project for Financial Center. You've got an affordable deal delivering on the south side of the river there, and then a lot of stuff in the East Village still coming. So I do think that in some respects, once you get to a certain point, it becomes not necessarily a detriment, but it becomes a market of itself, and it becomes a place people want to be. And so I think the more activity, really, the better over time. But definitely it's going to be about the flow and about the pace and about when those units deliver, and are they matching up with what the demand is for downtown.
Okay, we've got time for one more question, and this is going to be for all of you, and we'll do sort of a round robin quickly. Look into your crystal balls, and from each of your perspectives, tell us what you see for the residential sector in 2025. And Lance, I'll start with you.
I think one of the things Rachel brought it up on there, but insurance is a growing challenge, and it is going to continue to be a challenge in 25. And we need to be looking at how we can find solutions around that for residential housing.
Great, Sean.
I was going to say, Lance, insurance is a big one. On the transaction side, we're transacting a lot, or trying to. I think transactions will pick up on the multi-housing side on the acquisition front. It's going to. We need a steady treasury, whether that 10 years at 4.25, 3, and 3.75. It just needs to be steady. But we see there's a lot of pent up, supply of deals coming out that people want to sell. It's been a tough year to sell, so transactions should pick up next year.
Okay, Aaron.
I think that the longer housing affordability remains an issue, the more you're going to see the government stepping in to help. And in some cases, that's a big positive, obviously, with things like historic tax credits. I know there's a bill in Congress right now that was proposed last year, bipartisan bill, that would actually provide additional incentives for the conversion of office buildings to housing, not just, in Des Moines, but in any market. So I think that that's going to be a big push. And, to Rachel's point earlier, getting kind of some of that help, but without as much of the regulation that would maybe follow that, or stemming the tide of the discussion about rent control and things like that, is going to be part of the challenge as we go forward too. So I think it's going to be more and more of a public policy issue.
Thank you. Larry?
I agree with Aaron. I think, getting some of the regulation out of the building, new construction area is going to be big, and I think they'll be looking to help people in home ownership. And right now the purchase market is projected to be stronger than 2024. So I'm optimistic that we'll have a better year. I don't think it'll be substantially better, but I think it will be improved.
Rachel?
Thanks. I think that there's going to be a moderate pace of sales, and it's going to have those bursts of activity whenever those rates dip below that 6%. Even if it's momentarily, that's when you're going to see those bursts. I think that there are headwinds, again, with the tariffs and labor shortages. And like I said earlier, that potential deregulation is going to offer some relief. It's not going to fully offset the other challenges, but it will help. But a strong year, I think, in 25.
Thanks. And Sarah?
Agree with everybody. I think 2025 will be a strong year. One thing that hasn't been mentioned is that we can't forget 2024 has been an election year. And election years always are unusual. People have uncertainty in the market. So even immediately after the election was over, we saw an uptick in activity. I think 2025 will remain very stable. I don't think housing prices will go down. To Rachel's point, if there's even a little flurry of activity and lower interest rates, buyers will be out and are ready to buy. I think we'll see more buyers also purchasing new construction in areas that offer tax abatement, because again, those taxes and insurance are such a huge part of your monthly payments. If they're accepting the interest rates where they are right now, opportunities to have less monthly payments for taxes will be a huge help.
Great. Thank you. Thank you, everybody. Great discussion. Chris, it's back to you.
Right. Thank you, Kathy. Thank you, panelists. If you enjoyed today's programming, you want to dive a little bit deeper, this is our last event of 2024. So thanks for participating to cap off our year. We're getting ready for 2025, January 9th, book of lists. We've got a legislative virtual event on January 14th and our economic forecast on January 28th, which I'm sure we'll hit on a variety of the topics that we touched on today. Also, if you want to continue to stay engaged with Commercial Real Estate, our annual real estate magazine, we're hard at work already getting set for that publication, which came out in April, and we're getting ready for that for next year as well. Senior staff writers Kathy and Michael Crum are working right now on story ideas and planning for that publication, and our advertising team is looking for support for that as well. So if you're interested, you can reach out our way for that. And of course, we want to make sure you stay plugged in with Commercial Real Estate each week with our e-newsletter that comes out on Wednesdays. You can do that at businessrecord.com/sign up. And if you have story ideas for Kathy or Michael, please feel free to reach out. That's how we cover the community. We need to know about what you're interested in learning about. So please feel free to reach out our way. Thank you again for attending today. As a reminder, we make this series free and available to the community thanks to the support of our sponsors. So thanks again to Midwest One, DLR Group, and Iowa Finance Authority. We too are a locally owned business, and we're working hard to help this community continue to grow. So we appreciate your support in helping this program happen. Thank you to Kathy for putting together a great panel, a great group of panelists. We're lucky to have you in the community writing for our publication and for our community. And of course, to our speakers. We're so grateful you took the time today to be with us, to share your expertise with us and also with the community. We know we can't hear their applause, but we appreciate your time and energy as well. Thanks again for being here today. My name is Chris Konetsky. We're working hard each and every day to help build this community. If our staff can ever be of any help to you or your business, feel free to reach out. Thanks again. Have a great afternoon.